With a week behind us that has been dominated by China once again, the higher than expected inflation gauge out of the US and the rate cut from the RBNZ, it's time to look forward to a new week, and we've got plenty in store for you. Make sure to check out the entire video. I'll give you insights across the board when it comes to the data to look out for and potential trades that we'll be looking for in the week starting Monday, the 14th of October. So here are the big ticket items according to Trading Economics for the week ahead, starting off on Tuesday, really, with the unemployment rate. Essentially, that headlines up the jobs report for the UK. We've got the ZEW Economic Sentiment Index coming out of Germany, also inflation coming out of Canada. Wednesday, we've got that inflation theme continuing with CPI from the UK, but that's part of the inflation report that also sees the likes of PPI and RPI as well. And then on Thursday, we've got trade data out of Japan. We've got the rate decision from the ECB, retail sales from the US. And that leads us into Friday, where we've got inflation from Japan, a whole raft of Chinese data points headed up by, of course, that GDP figure, and then the retail sales number for the UK. So let's kick off. First and foremost, we're going to start off with the UK. The fact that we've got a huge amount of data essentially over the course of Tuesday, Wednesday, and Friday in particular. Jobs report Tuesday, Wednesday's inflation report, Thursday's the retail sales number. And so we should see plenty of volatility over the course of the week for the pound, potentially for the FTSE 100 as well. Let's pick through it. Firstly, I would say one of the most notable parts of this should be the unemployment rate. And you can see exactly that here, 4.1%, expected to rise up to 4.6%. According to these estimates. A potential spike in unemployment, of course, when we were looking at the US, when we saw a move up by 0.2%, everyone started calling for a recession. Well, this is up by 0.5% potentially. And so this really could highlight the possibility of increased pressure on the Bank of England if we suddenly see the potential downturn in terms of the economy and a spike in terms of unemployment. Then we could possibly see some pressure being placed on the Bank of England to act in a more dramatic manner going forward. The claimant count, we're expecting to see a decline on that figure, minus 15K. In terms of the inflation metrics, it's really about that core number, 3.2 from 3.6 expected. And this really is a theme that we're seeing around the world, certainly with the Western world pointing towards inflation, headline inflation being relatively close to target, but that core metric generally relatively higher. And so we really want to see those core inflation numbers moving towards the downside. So this 0.4% decline, which is what markets are looking for, could come as a welcome development. Certainly if that comes alongside the unemployment rate spike, that could point towards faster pace of easing when it comes to the Bank of England. And then the retail sales, we'll get into that through some of these slides. So first and foremost, here is the outlook in terms of wages in the UK. And we can see here in terms of the green line, inflation leads wages. And so as you see inflation rise, so people request higher wages. When inflation declines and inflation expectations decline, then of course you're then going to look for people to maybe ease back in terms of their expectations for wages, and those wage declines or the rate of growth for wages then eases that underlying inflation pressure. So we need to see wages come down. That's the expectation here in terms of what you're seeing here. Market expectations for average earnings, including bonus, 4%. And then in terms of excluding bonus, down to 4.8% from 5.1. So decline expected on that metric in particular. Here's that outlook in terms of the unemployment rate. Now, this is an interesting chart because essentially it highlights the sort of leading move that we'd seen from the unemployment metric that comes from the claimant count compared to that headline LFS metric. We hadn't necessarily seen a major spike. You can see 4.2%. And so with the surge that we've seen in terms of the claimant count metric of unemployment, we're now expecting to see the same kind of thing. We're now expecting to see a surge for UK unemployment. Could the potential for both of those bottoming out signal the need for further action from the Bank of England? This is just a chart that I always find interesting, and this highlights the trajectory for retail sales. What we had seen is a move away from the historical norm, which is that the two move in tandem. And we saw them diverge. So essentially, people were paying more but receiving less. And that shows this massive inflation crisis that we've seen, the cost of living crisis we've seen in the UK. But that's changed. More recently, they appear to be moving in tandem. Look, if I was to index them into, say 6 months ago, they're moving pretty much in lockstep. So it does feel like the trajectory, the divergence over the course of 2022 in particular, and in through much of 2023, that appears to be over, and they appear to be moving towards the upside for both of them. So this is a positive development. People were happy to continue to spend more, but now, thankfully, they're spending more and they're receiving more as well. That really does feed into itself, and people are happy to continue to spend more as long as they are receiving more. And that hasn't necessarily been the case in the past, and that does provide a tailwind for the UK economy going forward. In terms of UK inflation, the headline number at 2.2%. What's interesting here is that we're seeing the 0.5 figure dropping out. So whilst markets are expecting to see it relatively flat, I think it's likely we're going to see further downside in terms of headline inflation this time around in particular. But for then on in the back end of this year, October, November, December, less so, but January, certainly, there's a good chance that we see inflation maybe moving sideways or moving towards the upside for the months ahead. So this could be the final month of disinflation when it comes to headline inflation. So take that all together. If you're looking at the UK, and what do we get? Well, we get the potential for a surge in terms of unemployment, a decline in terms of inflation, a decline in terms of wage pressures, and therefore taking it all as one, you're looking towards probably likeliness of greater confidence that we're going to see a rate cut from the Bank of England. So as you see here, market's currently pricing in a 21% chance that we don't even see a change in November. Of course, we don't have a meeting in October. So 78% chance that we see a rate cut. I think there's a good chance that that might shift more in favor of a rate cut going forward. And then beyond that, you can see the December meeting. There's just a 48% expectation that we see another 25 basis point cut from there. So certainly markets are hesitant about the idea that Bank of England are going to cut rates every meeting, despite the fact that certainly that is the expectation when it comes to the Federal Reserve. Now, in terms of a market to look out for, I wanted to look at the chart for, well, sorry, I just seem to messed it all up a little bit there. There we go. Right, let me just grab this chart for you, and it is the right chart. There we go. I accidentally took it out of the window that it was in. Right, so this is the pound against the New Zealand dollar. Look, ultimately, I was looking through different charts of the pounds. I wanted to find something that was most interesting. We've got a very clear uptrend in play here. This is the weekly time frame. And what I find interesting is this pullback into trendline support, into that deep Fibonacci retracement zone, and the potential bottoming out that we've seen here for the pound against the Kiwi dollar. So as we see here, the creation of lower highs, lower lows, that ABC style retracement into that deep fib zone, then rally, higher low, flatlining low, higher low, so that kind of area. Ascending trend line support, rally up through resistance. So now higher highs, tentative higher low. And so this for me looks likely to see further upside to come. If we do see, particular weakness for the UK economy, like that surge in terms of unemployment, and we see very weak inflation numbers, maybe that does start to see this come off in a way over the near term and pull into another retracement once again. But unless we see this 2.1 support level taken out, I think there's a good chance we've bottomed out here, and there's a good chance we see a continuation of this wider uptrend coming into play once again. So a break below 2.1 negates that move. But until that happens, even if we do see sort of weak economics, weak inflation, that could just pull us into a retracement zone. And so whether we pull back into here and rally, or if we push upwards from here, I think the uptrend does clearly point towards a possibility of further gains to come, given the strong bull market that has been playing out since the lows that we saw pretty much a year ago here for sterling against the New Zealand dollar. Next up It's all about China. Now, China, of course, has been at the forefront of the market's focus really recently, and that has come because of the fact that they're cutting rates. They're making it easier for people to buy second homes. They're making it easier for people to buy homes in other cities that they don't live in. They're encouraging people to be able to invest more in the stock markets. So it's all happening at the moment. Now, what's notable is that we've seen some volatility recently because apparently every single time that we hear from different parties and bodies within China, we're expecting to see more stimulus, right? And so at some point that was going to stop. And certainly markets at the moment are sort of taking a bit of a breather. What we have got ahead is a particularly busy Friday. You can see here house prices, GDP, industrial production, retail sales, fixed asset investment, the quarterly GDP as well, unemployment rate, industrial capacity utilization. I mean, there's a lot. There is a lot, quite frankly. And it's difficult to know exactly what markets are going to sort of grab onto. What I would say is it feels like we've been through a period where everyone's just concentrating on, how much stimulus can we see from the PBOC? And we're going to have to get into a position where we need to see the reaction. What's the economy going to look like going forward? Are we going to start to see it feeding through and we start to see beneficial impacts from these stimulus measures? Well, it doesn't happen instantaneously, quite frankly. Of course, we started to see those measures announced in September. It's probably unlikely we're going to see them in this data set. But certainly as we move forward, we'll have to keep a very close eye on this data, because if we see things start to turn towards the upside, it's really likely to fuel that second period of upside. But for the time being, it's all about sentiment. It's all about sentiment. So look out for some of these data points. Look, ultimately, I think a lot of them are going to look like they're on a similar trajectory. Here's the trajectory for house prices in China. So when we're looking at house price metrics, you've got to be aware of the fact that the weakness in the housing market has been key to underlying and why the economy has been so weak. So many people have money tied up in the housing market. And when we see weakness playing out in the way it has, then of course people are essentially hamstrung in terms of their investment decisions and the likeliness that they're going to actually spend more money and start investing or build businesses and the like. GDP wise, you can see here, I would say that the notable part of it for me is the quarterly metrics that we can see here in the sort of orange histogram. Probably be a bit easier if I made them bigger, quite frankly. But nonetheless, the pre-pandemic average is sort of 1.7% per quarter. We're well below that. If I just flick back to the previous page, so we're expecting it at 1.2 this time, up from 0.7%. Still well below what is the norm, but certainly that would be a welcome development considering where things were when we were looking at them last time around, which was in Q2. So certainly that GDP number is going to be important. And then this is the sort of outlook for where things are in terms of policy from the PBOC, and part of why markets are so optimistic at the moment. And that is that we've seen further downside in terms of reserve requirement ratios, which is the amount of money that banks have to essentially keep as capital, the rest of which they can lend out if they wish. So if you're cutting the reserve requirement ratio, then you're making it so that they can lend out more of the capital they have. But the question mark is whether it's down to the banks not wanting to lend or being able to lend because of the policies, or whether it's down to businesses and individuals not being willing to take on those loans to invest because they want to see the economy bottom out. And this could be that moment. We can also see here some other key interest rates in China with the sharp declines that we've recently seen in September, highlighting that shift that we've seen in China and why people feel so emboldened right now. In terms of the markets to watch, look, we've all been talking about the Hang Seng in particular, but also mainland Chinese markets. But I wanted to bring up the US dollar against the Chinese yuan because I think this is arguably just as interesting. The wider trend shows you this massive rally in particular throughout 2022, taking us into this peak here in September. So roughly a year ago of 2023. What have we seen since? Well, we've seen this sharp decline coming into play. More recently, we've seen this rebound. That really tallies up with what's happening elsewhere. If we look at, here we go. If we look at, say, the Hang Seng, you can see the sharp decline coming into play here. So that sort of reversal of this recent trend is also playing out here for the Hang Seng. But nonetheless, we can see here the trend that has been playing out over recent months has been a bearish one. So people coming back into the Chinese yuan, and you can see that it's starting to fade somewhat, the recent rally, this retracement, notably at the 76.4 Fibonacci retracement, starting to roll over in my mind. So unless we break the 7.136 swing high, I think there's a good chance that we see the bears coming back into play. Now, that would be particularly prominent and prevalent if we see the economic data start to improve as we go forward for China. Whether that will happen or not remains to be seen, but certainly the rally that we've been seeing appears to me to be a breather. And certainly there's plenty of people out there that think that we're at the beginning, at the inception of this move for Chinese equities. And that could also mean the inception for the resurgence of the Chinese yuan. So a potential sort of rolling over for this pair would be particularly interesting. Different ways of playing it. Again, you can look for it to roll over from here. You can look for a double top formation with a breakthrough 70456. Different ways of playing. But ultimately, my view is this rally looks like it could be losing momentum, and certainly with the bearish trend that has been playing out of late, unless we see a breakthrough 7.136, this does look like we could start to see it roll over. Let me just quickly take a look at something like a CCI sort of momentum indicator and see exactly how that's playing out. So we're sort of the most overbought that we've been over the course of the past few months. And so, if we start to roll over, we haven't got into sort of overbought territory. But, if we start to see that roll over, you'd also get greater confidence that momentum's starting to fade for this currency pair. And then finally, I wanted to bring up the Eurozone region. Of course, we're looking for the ECB to cut rates once again, as you can see at the bottom section of this. We've also got some data coming out of Germany in particular, which we're quite used to being relatively dour. What we're expecting? Well, we're expecting the ZEW Economic Sentiment Index to drop to -1 from 3.6. So yeah, no change there, quite frankly. In terms of the ECB meeting, the reason why I find this particularly interesting is the fact that this is a meeting that some other central banks don't have, right? There's no Fed meeting in October. There's no Bank of England meeting in October. And there had been an expectation that the ECB would hold out because they don't necessarily want to widen that gap between their rates and the rates elsewhere. Remember, they didn't raise rates to the same degree that like the US did or the UK did. And so when we see those low interest rates out of the Eurozone, you're likely to see people allocate their money elsewhere. If you can get a fixed return in Europe that is significantly lower than the US, it's not like the US is a big risk. So it's likely that people will move their money elsewhere. So they don't necessarily want to widen that gap. And the wider that gap goes, the more likely you are to see sort of weakness in terms of the euro. Now, a few different things I've put together. First and foremost, this sort of gives you an overview of where things are from an economic perspective, because I've compared the PMI numbers from the likes of Canada, the Eurozone, Australia, the US, and the UK. We can see from a composite perspective, the US is in best shape, but the UK doing relatively well, 52.6. So that would point towards the possibility that maybe the Bank of England are in a good position to be able to hold off for the time being. The Eurozone at 49.6 points towards them potentially needing to act. They're below that 50 threshold, so in contraction territory for the sort of wider economy. You can see that's predominantly driven by manufacturing, 45 on manufacturing, 51.4 on services. So they're doing all right on the services side of things. That is a theme that we still see for most major countries, apart from Canada. As you can see here, we can see manufacturing in Canada at 50.4, but we can see on the services side of thing at 47.8. So from an economic perspective, they're below that 50 threshold on the composite PMI number. You can see here in terms of inflation, we have seen them manage to drive down core inflation much more so than their neighbors. You can see here 2.7% on core CPI. Compare that to 3.6 in the UK for the latest reading, and then 3.3 for the US for September. You can see that they've done a better job. So they are in a good position to be able to cut interest rates if they deem it necessary. As you can see here, their deposit rate is already well below some of the headline rates that we're seeing for other central banks. They also cut rates ahead of many of the other central banks. So They have already cut rates quite significantly. They are already significantly below their counterparts. But with the fact that inflation is declining and the fact that they need a kick up the behind, it appears, certainly if you look at the numbers coming out of Germany, there's a good chance we see them cut rates once again. You can see here markets expecting a 96% or pricing in a 96% chance of a rate cut this time around. Then 97% chance that we cut in December as well. Then things start to get a little bit more mixed. January, 64% chance that we see another 25 basis points, 67% chance that we see another. So by and large, we are seeing it heavily priced in terms of 25 basis point cut at every meeting up until April. And that's when it's relatively split, just 41% chance that we see another one from there on in. And things settle, but ultimately markets, are likely to be more accurate the closer we are to the event itself. And the further out you are, the greater degree of uncertainty you're likely to see for these markets. I wanted to round up this video by covering the DAX. Now, the DAX is a really interesting one because, quite frankly, if you're looking at a market that is related to an economy that really has been struggling, you might not necessarily think that it's going to do that well, but it has been a really strong performer. I can show you that over long term. You see the last year has just gone up and up and up. Let's see exactly what the last year did in terms of percentage terms. Up 26% over the course of the last year. And you can see that we did reach record highs just recently, pulled back a little bit from here, but you can see sort of rally into record high, mid to sort of, that's 38.2, I'm almost certain, retracement, then a rally into a similar kind of retracement. So relatively shallow retracements that we're seeing at the moment, and then starting to turn higher once again. What's notable here is that retracement appears to be over with the fact that we've seen again an A, B, C style retracement, the rally up through your initial swing high. That points towards the current retracement being exactly that, likely a retracement. We could come down here, we could come in here, but either way, unless we see a breakdown through this near-term swing low of 189.11, then we're expecting to see this essentially represent a retracement phase before we see the bulls back into play once again. Whether we come into a deep retracement or not, that sort of remains to be seen, but I think there's a good chance that the bulls are going to be in play here. And certainly if we see the ECB continue to cut at every meeting and their rates are relatively low, then, it does look an advantageous situation for further upside for the DAX. So like I said, 189.11, if we see a breakdown through that support level, then it starts to look like we could see further downside. But until then, I think there's a good chance that we see the bulls coming back into play once again for the DAX in a week that is going to see the ECB in all likeliness cut interest rates according to market expectations of near enough 96%, I think it was, expectation for a rate cut. So a busy week ahead and plenty for us to sink our teeth into. I hope this has been useful. Make sure to follow us for plenty more video content in the near future. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great week ahead.